Good morning. It is May 19th, 2020, and we're going to cover a new piece that I put out this morning on different scenarios for the stock market. And then we're going to buzz through some of our favorite growth stocks, several of which I think get added to the S&P 500 next month. So we should probably try to find ways to get into these stocks on almost any pullback. Might not be the cheapest approach, but it's something that we can probably improve. So let me get started again with the article. This has a different title for Seeking Alpha, but it's really stock market scenarios and indicators of what comes next. Short term, market is a popularity contest, and long term, the market is a weighing machine. Some guy in Omaha. The short term, since March 24th, the stock market has been very popular. We know that the majority of the investors have been small investors and traders. You are not seeing the rich through family offices or the institutions through their funds investing. So this is very much a small investor-driven rally, up around 30% from the bottom. Which is about 2/3 of the correction. This chart, I just want to show that on a longer term time frame, there are pretty strong support levels around 273.4, and then again 256, 257 on the SPY, and we are getting into a zone here, which we've identified weeks ago, from about 294 to the low 300s, where stock market probably stops rising unless we get the to the moon scenario towards new highs, which could happen. If it breaks through the top of this box, got an awful long way up to go. But I would suspect that at one of these levels, right here is a very strong one, about 304. And we're at a pretty strong resistance right now. So we're flirting with these levels that are just below 300 and hitting even more strong support. Again, right around 304, 305. It's pretty strong in here, 306, 307, 308. That's a lot of resistance right in here. I in the absence of really good economic news, I'd be surprised to see us go out of this box to the top. I think it's more likely that we bounce back down. And I'll cover a couple of scenarios here. This first scenario is if we really are in a new bull market. So if we really are in a new bull market, we probably get a pullback out of this box down to the first yellow line, about 273, 74 on the SPY. Could even go down to this 256, 257 level and still really be in a potential bull market, although it becomes very iffy down here. So I think that if you're a bull believer, if you think we're in a new bull market or a continuation of the old one, then you want to be a buyer in the middle to low 270s on SPY. So you'll make your corresponding trades to whatever vehicle you want as SPY gets down to these levels. The coronavirus crash 2 scenario, which I'm afraid of, would happen if there's a massive, if the massive intermediate term economic damage matters, or because of the emergence of zombies in the S&P 500, another round of layoffs from after the payroll protection program loans convert to grants, a wave of bankruptcies towards the end of the year, and commercial real estate getting thumped. So to me, all of these things are in play and are likely. So to me, I think the coronavirus crash number two, second coronavirus crash is likely. In that case, probably blow through this yellow line, go down to the second yellow line, and then it's a matter of, can the market hold? Could be massive government intervention, Fed intervention, and maybe this holds here, and then you're looking at a higher low, which would indicate that we're probably going to see another rally. I think the more likely scenario is that we see the stock market drop to this area and possibly lower. So there was a huge battle zone in 2014 to 16, this area here, where the stock market popped around. And this was a narrow range than when it popped around in here for a couple of years, right? So right here, it popped around for a couple of years, then broke out in 2019. Down here, same thing, popped around in the same area for a couple of years. Trump gets elected off of that bottom, and we get the first big rally, more chopping around, another big rally. I'm not going to project too much here, but the markets often have an ulterior motive. Sometimes these ulterior motives are largely reminiscent of what the super big money wants. And the super big money, the family offices, are not investing in equities right now. They have been net sellers for over a year and a half, which we've talked about several times. So from the end of 2018 all through last year and into early this year, the family offices, which control the net worths of many, if not most people who have 8 and 9 and 10 figure net worths, have not been investors in the stock market because they feel the market is overvalued, maybe something to do with taxes. For whatever reasons, they've reduced their equity asset allocation. So again, that points to the fact that this is a small investor-driven rally. If enough of the big money wants to see President Trump gone, then the easiest way to do that is to not be involved in buying equities, to sit on your wealth and let your checkbook just be a checkbook when better prices manifest. This battle zone here, 2014, 15, 16, manifests because of the subsequent price action, massive support levels down here. From about 220 on the S&P 500 all the way down to a little above 200. So this area right here, you see where all those lines overlap? All those lines together, that's a pretty big support zone. So if the stock market does have another wave of correction, my guess is that we probably should be pretty big buyers in here. 208 SPY, maybe even a little higher, from about 220 down to 208. You're going to want to be selling puts and buying stock. You have to measure it based on the momentum at the time, which, if there's panic, could go through these levels pretty big. And I think that about here is where you're going to see really big money getting involved. I mean, that's where you start to see the wealthy just buying stocks hand over fist. So from about 220 down to about 190, 187, huge buying area. You'd want to be a buy the dips person down in there. I think this is the most likely scenario. Now, because there's stocks I want to own, as we pull back to the 270s on SPY, I'm going to have to get into some of the stocks that we'll cover later on today. But I don't think I'll be a major buyer of long-term holdings with the ETFs, other than I would probably buy some QQQ to trade if it looks like it was going to bounce off of this and then rally again. And again, that would be a game time decision. The Armageddon scenario is that we get a wicked second wave of coronavirus, which is probably probable. Hard to know. But we are seeing all the coronavirus infection curves rise again. and not just the absolute numbers, but based on percentages of people tested that are testing positive, and the deaths outside of the New York City area are rising throughout the country again. So it's my belief that the economy is tied to people's confidence and their fear. And if they are afraid of getting sick, they're not going to go out and spend money. It's really that simple. I will tell you, I brought $400 to 400 and change to Arizona for spring training in the middle of March. As of yesterday, I still had $125 in my wallet after 2 months, just not spending. And I'm one of those people that you want spending, but I haven't been. And there's a lot of people out there who aren't spending. So they are hanging out near home and not and basically sitting on their wallets. So if a second wave, really invalidates the V-shaped recovery thesis, and if the government and Federal Reserve, shit the bed, and if there's a trade conflict that disrupts supply chains, under these three scenarios, these three things coinciding, we could get the Armageddon scenario. What is the Armageddon scenario? That would be the S&P 500 getting all the way back into this range, which shouldn't happen, but it's on the table because I think that it is reasonable to say this is not impossible, right? So whatever is impossible might happen, and this isn't even impossible. I mean, all three of these things could happen. Coronavirus could come back with a wicked second wave. The government and central banks, the central bank could run out of firepower to a certain extent. And, you could see no more legislation get done. And then the trade conflicts, which you've seen in the news, are ramping up again because everybody wants to point the finger at China for their own, their own shortcomings in many cases. So if the trade war spikes out of control again and supply chains are disrupted, I mean, think about what that means just for deploying a vaccine. So I would probably be about 90% invested in this area in here, and I probably add probably get to about 60-70% invested in here, about 90% invested in here. Here, I would find everything that I could sell. I'd sell my baseball cards. I'd sell everything to buy stocks and real estate down here. Again, I don't think it's likely, but it argues for the idea that you should always have 5 or 10% of your portfolio in cash, just in case Armageddon happens unexpectedly. Bruce Willis can't save us this time, sort of stuff. I can't reasonably say what the percentage is for here, but it's low. It's higher than the non-existent level that I'd like to see right now. So what are some short-term signs that we got trouble? So the CBOE equity put call ratio, which we've talked about before, anytime it opens up alligator jaws, you get a correction. And right now we got alligator jaws. Less than half the half the activity is puts. So the calls outnumber the puts about 2 to 1, and that is just that's reminiscent of a greedy market that's very complacent about risk, and usually the alligator snaps shut. Now, this can go lower, right? It can keep rallying, and the put to call ratio can go lower, but we're getting close to that point, that 2 to 1 range where, it pretty much always snaps shut. I mean, you can just look at the chart. Whenever you get a local high, and then a low in the put call ratio, it snaps shut. And some corrections are bigger than others, right? This one was early 2018, that's the volatility events that we traded. And this was the end of 2018, and that was a pretty bad one. A couple smaller ones, a bite, a couple nibbles, and then another munch. Big correction recently. So we're going to have somewhere between a nibble, a bite, and a bunch when the alligator, crocodile, whatever that is, closes its jaws again soon. So you want to be cutting your equity positions down to close to what your minimum equity level would be for your asset allocation range. Many people never go below half in equity, and that's fine. If you're 75% equities right now and half is your lower bound, get to half. If you are willing to go down to 25% equities, or like I am, I'm 50% equities, but everything's got cover calls. So I really don't have much exposure unless the market drops over 10%. Do something like that. Get to the lower bound of what your equity asset allocation would be. So if you believe that we're going to see the second coronavirus crash, and your lower, the least amount that you'd ever have in equities is 25%, you should be trying to get there right now, or 50%, or whatever your number is. The intermediate term sign is that we have extremely high valuations, never have gotten really below the second standard deviation level. So we were at the third standard deviation when the correction hit. My argument is that the correction was going to happen anyway. Coronavirus just spurred it, and now we're getting all these people chasing money back in the stocks. Valuations are going to continue to get worse because the E in PE, the number on the bottom, the earnings are going to keep getting worse throughout this year. You're not going to see an earnings rebound start until probably the second half of 2021, so over a year from now. Can we maintain this level of valuation in the face of all that bad news? Historically, no. But hey, maybe it is different this time. Those are very dangerous words, by the way, for those of you who didn't catch that. This is the Buffett indicator. So let's talk about Warren Buffett. He is holding a record amount of cash. He sold airlines, he sold banks, right? Warren Buffett sold bank stocks recently. And I think that's a very telling sign. So this is his favorite indicator of when to be a buyer, when to be a seller. He's been a seller up here, raising the biggest level of cash he's ever had. And then in 2009, he was a buyer when the valuation of businesses went below what you could reasonably buy in the stock market. So I don't know that we'll see this. That would be kind of the Armageddon scenario. But for sure, you'd think that we'd get kind of in this area here, which indicates 25 to, what is that, 25 to 35% drop in the stock market, which is what I've been talking about. So this area in here is where I think we're probably headed. And if things get really bad, we could head down here. I don't think that's going to happen, but we have to be open-minded about the possibilities. So again, I don't believe in hopium. So here's the long-term reality. You don't want to bet against America long-term, right? All these people who have been talking about the collapse of the dollar since 15, 20 years ago, as far as I can remember, they've been wrong. Dollar's been rallying since after the financial crisis, which I wrote articles on Market Watch saying that's what would happen. The dollar will continue to be strong for the rest of your lives. Now, will it ebb and flow 5 or 10% in either direction? For sure. And can you trade currency markets if you were so inclined? But the reality is the dollar will be the reserve currency for the rest of your life. It may get defrayed a little bit by special drawing rights through the IMF, which we're a major shareholder in, and have a major influence on. So in which case, maybe the yuan becomes a little bit more internationalized. But remember, The communists control a lot of things, so in their own country. So that means that their trustworthiness around the rest of the world isn't all that high. So who would rather have yuan than dollars? The only yuan you want to hold is for trade that you would do with China. The United States is in a great position long term. I think we're going to print, you've heard me say 20, $30 trillion a couple of years ago. I bumped that up to 30 to $40 trillion recently. The more I look at it, the more I think we're going to print 50, 60, $70 trillion eventually, and in the next decade. And it's not going to cause much inflation. Why? Because we have such strong deflationary forces because of demographics that printing an economy, as long as we trickle the money in through pensions and Social Security and Medicare and 10-year infrastructure projects and everything else, it just ends up being an offset to deflation. And as long as we pay off a whole bunch of debts when we do it, and normalize interest rates a bit when we do it, which I think is, if you took a look at the bond article yesterday, I allude to that. Printing all that money isn't going to be that big of a deal. That sounds completely counter to what a lot of you hear, but consider that we're basically $100 trillion in debt when you had everything up, and you go, what's another 50 trillion? Right? I mean, that's really what it comes down to. And especially in a world of relativism where everybody else is doing it too. So as an investor, you have to think, okay, if there's going to be devaluation of bonds, right, because interest rates will go up when there's a printing of money, but it's really just offsetting deflation, where do I put my money? Where's my money going to behave best? I really like the gold miners. The price of gold goes to 3,000, which I think is likely. Those gold miners who are profiting on everything above 1,000, because that's what it costs them to get it out of the ground per ounce, they're dropping an awful lot of money to the bottom line. How many of you are loving the Newmont stock that we bought last year? So, or the gold miners that we loaded up on March 16th. So there's you don't have to have a lot of moving parts to manage this. You just have to have an understanding that there are certain things that are going to do well over time, and in the long run, don't bet against America, because we have everything you need to be successful. If America's not successful, nobody else will be either. And the world just keeps getting better, right? Even though we have our setbacks, take a look at some of the stuff that I've put in the very short list from time to time, some of the articles I've written. Literacy goes up, health gets better, fewer people dying in war, higher standards of living, even though there's great wealth disparity. Go across the board. Look, the world's getting better. We just have a step back every now and then. And because it's so easy to get bad news on the internet and on TV, it feels sometimes worse than it is. Now, coronavirus is horrible, and I don't think we're managing it well. And that's, something we're going to have to get through over the next year or two. Asset allocation now. I believe the coronavirus crash scenario is the most likely, but that doesn't mean that I'm right. And so you're going to have to scale in at different prices to hedge against the idea that we're wrong in our judgments, right? Sometimes the market is smarter than us, not often, but every now and then. And so if the market gets down to that 274 to 251 range, you've got to be buying something, right? You don't have to buy a lot of it, but you got to buy some. And you have to find your very best ideas, and that's what you go with. I won't be buying SPY, you know that. But I would buy QQQ, a little bit of it at 170. And again, depending on what's going on in the market around those prices, you figure out, do I have to put this up a little or I lower it a little? And then QQQ around 150 is another price area that I've got targeted. Could the QQQ go all the way down to around 120? Yeah, in the Armageddon scenario, we could see QQQ way down at 120. That'd be a 50% loss from here. And I think that's about as bad as it can get. But we'll see. I don't think it gets terribly much worse. So make sure you take a look at the 67-page coronavirus report because there's a lot of good ideas in there. So we'll cover some of that. Some things I just want to fly through here. America's zombie companies are multiplying and fueling the new risks. Didn't I just write the article about sell your zombie companies? And I've been talking about this for months and months and months. Again, a lot of these things were going to happen with or without coronavirus. The new economy is the new economy, and now it's coming faster than ever because of the whole work from home environment. So things that we thought would happen over 10 years happening over the next 2. So again, here's the areas where I'm looking to buy QQQ around 170, around 150, and I guess it could get down to 120, and really the Armageddon scenario. Yeah, that's about right, about 120. I don't think we see around 120. I really don't, but it's something to keep in mind. So we have a bunch of growth stocks I'm going to fly through really quick here that I want to focus on. Really anything in the honorable mentions is in play. And then we had our top 10. Google, I think Google around 1,000 is something you need to take a look at. Alibaba, I put way up on the top of the list. It gets down to 170 again. I think you've got to buy it or sell puts. And 150, you probably really got to back up the truck. Square has been bouncing around. So I think you get another chance around 50. Probably buy some. If we have a worse coronavirus crash than I expect, or the bottom end of it anyway, then you could get it down in the 30s. And I really think you got to own this one. Square has so many fires in the irons in the fire that they can't help but win over time. And they're an acquisition target, and they're probably getting added to the S&P 500 in June. Now, Enphase isn't close to getting into the S&P 500, but look at this chart. Now, most of this to around here is legit based on what they're earning and what they're going to earn in the next year or two. This, I will just mention Reddit here. On Reddit, some of those groups in Reddit, they pump stocks up by buying calls and calls and calls, and then they dump the calls and the stock comes back down. You saw it in Tesla. You've seen it here. So this one is one that I think I want to buy in 30s. I'd for sure load up in the 20s. Roku, he had a nice rally that has fallen back recently. I think that right around 100-ish, I think you got a nibble on it. Down around 80, I think you get pretty fully involved. Could it go all the way back down to 60s? Yeah, sure. Then you'd have to, really buy it. But when we take a look at scaling in, a lot of people, when they average down, it's like every dollar they buy down. No, you got to look for the big support areas. So I skipped this one because I already bought up here. So around 100, around 80, around 60 is where I want to buy Roku. I've been using them now for a couple of years, and I tell you what, they're going to be able to monetize so many things, and they are the natural player for doing bundles, right? So right now, people are getting rid of their cable bundles, but then they go out and buy 5 streaming services. Eventually, Roku is going to be able to package multiple streaming services in discount packages. So get Hulu, Disney, and something else, or get this, that, and the other thing. They're going to be able to do those bundles. You'll get a 10% or 20% discount. Then Roku takes their cut for, generating the sales. So, Roku's got an awful lot of ways to monetize. I think that their product is the best one out there by far. Yeah, I don't think it's close. I think they're leaps and bounds ahead of everybody else. So you definitely want to get involved with this company. Again, another company that could be added to the S&P 500 imminently. PTC, augmented reality for industry. Again, get it around 60, get it around 45. I think you got to buy it. Could it go way down here on some horrible situations? It could. Don't think it will. But, you know, you see this box right here. I'd be for sure buying in the 40s. And again, you can sell. One strategy is when it gets down to the yellow line, instead of buying the stock, sell the put with like a $60 strike price, and try to figure out where you think the market's going to correct 2-3 months out, if that's what you think, and you just collect some of the premium for in here. But you really do want the stock assigned to you, so you don't want to sell it lower. You take the biggest premium you can, then hope it gets assigned to you. Workday has been turning over, and it's got a history of doing things like that. You know, it's turned over here. Now it's up here. I don't know that I'd buy it at 140, but I think for this one anyway, I think right around 120. I don't know that it gets added to the S&P 500 this go around. It might. I think I'd probably put them lower on my list at this point, but probably still top 10. Zendesk, same deal. Look at these pops. Now they're turning over. Again, I'm looking at these red lines. I think is the more likely buy point for me. You can certainly nibble in up here, but I think this is where I want them. Teladoc has gone straight up. They're going to have a lot of competition, so we have to do a better measure of what their cash flows will really truly be. And it seems like the market is telling us that this is the zone to be in, just above that peak, and then this breakout. So it comes back. But really, we have to do some hardcore math on this one. This one's a harder one to invest in, and I don't know that it really is in my top 10 anymore. But it's going to get added to the S&P 500, so that's why it's on this list. Shopify, Canadian, not going to the S&P 500. And this chart is obnoxious for a whole bunch of reasons. One of which is that they charge a subscription fee, which we know the subscription fees are a great revenue model. But entrepreneurs, especially a lot of these people who are going to be working from home in the future, and a lot of people who got displaced, but they have some skills. You know, I've got my son working on, and he actually did it himself, so I just encouraged him once he told me. He's looking to basically do what Shopify is doing, but just locally. So rather than paying a fee, monthly fee that ends up being more expensive, he's going to business and saying, look, I'll do 3 things for you. I'll build your website, I'll maintain it, and then if you want me to do marketing, I'll take a percentage. And you don't have to pay me money up front. Well, there's a lot of competition that Shopify could have. So as good as they've been, the better investment would have been way back here. I think this comes back all the way to the yellow line for sure. And right in this yellow to red line area is probably where I'd be interested. I don't think I'll be interested way up here. Itron, because I think there's a massive infrastructure deal coming. This moves way up my list, I think. I think I probably should have had it higher to begin with. It gets back into this 50 to 30 zone. I'm going to buy some. I hope I can get it in the 30s, but even if I got it close to 50, I think I'd be happy with that. And look at how this box shapes up. Look, that area right in here is resistance, then support, and then new supports, goes through the resistance, hits the support. So I don't know if it stops going down around here or closer to here, but it's those 2 lines, right? So if we were going to put lines in, which we tend to do, probably say that this is the, what just happened? That's not what I want. Wrong. There you go. So this one would be our yellow line. All right. And then this one would be our red line, the other spot where we buy. So I think that this is a good spot to just note, you know, when you see the lines, they don't represent a line, they represent a range. So from yellow down to red is the range. that this bounced around in. And there's multiple support zones in here, some of these different peaks and, you know, bouncing around. But look, this is the big one. Gets above here, breaks out, and it's come back down to this a couple of times. So maybe this is just a shade lower, right? So you take their box and you make your box a little bit bigger. You know, I had a professor in economics way back when I was a freshman or sophomore in college. He said, you know, when you're making a chart and your lines aren't perfect, you know what you do? Make the dot bigger. Right? Same thing, just make your box a little bit bigger. So from a little under 50 to around 30, you know, I think I'd probably buy around here, right around 50, and then I'd wait, and if it got close to 30, I'd buy it again. I'll save that one. Electronic arts. Now that I have a gaming computer, I've been learning more and more about games, even though I have yet to play one. I did load one. I did load one from when I was a teenager. I loaded Gradius, first horizontal war game. And I have not played yet, but I'm taking baby steps getting there. I think electronic arts is something that we really want to look at. You know, let's put it to the weekly chart. If it gets oversold, remember we were looking for oversolds on multiple indicators. You know, under 100, I think we really have to look at this one, right? Under 100 is, I think, an important price level. But, you know, I think where we really want to buy it is down here around 80-ish. You know, look, resistance, bounces off, goes through, hits it again, comes back up. So, you know, this level from the most recent correction and from December 2018, which is, you know, 80-ish and 90-ish, probably where you want to buy electronic arts. It coincides with market structure going way back here too, you know, to very early in the Trump administration and late in the Obama administration. So again, another one of these boxes gets back into this box down here. You probably want to buy electronic arts. I gotta say, these guys just print money, and at some point you just have to respect it. And if you can get the right price, it ends up being a pretty easy 20-30% trade. NVIDIA should definitely be higher up on my list, but it's chronically freaking expensive. We should have bought a ton more of it here. You know, I told people to nibble, but we should have just backed up the truck, right? You know, I don't know that we see prices down at 130 again. That was something that happened because the cryptocurrency mining was falling off, and we weren't quite to the AI age. Well, now we're getting well into the AI age, and I think that any pullback to about this level, about 175-ish, is probably where we're going to want to be. I'll draw this out for you better, but I already played with it once. 175-ish, 180-ish. I mean, this is probably the best we're going to do if we want to get it. We might just stick with the semiconductor ETF as well. Finally, we'll finish off with Micron. Micron has huge back orders. If we can pick them up anywhere in the 30s, you probably want it. Because ultimately, the DRAM market that they dominate, and then some of the other things, you know, they're one of 3 companies in DRAM. Everything that's coming with artificial intelligence and IoT and the edge computing, machine learning, augmented reality, all these things require semiconductor, and the new technologies that are coming, which Micron has taken a part in, are going to be a big deal. So at CES, they talked about machine vision. And I think that the deal that Microsoft and Sony just did yesterday to basically put everything on one chip for AI, where basically it's going to look at something and figure it out. It's going to think just like us. It's going to look, it's going to think, it's going to figure it out like a zillion times faster. So that's going to be good for these guys because the databases all need memory. Could these guys get all the way to the low 30s? They could. Low 30s, I'm backing up the truck. You know, this was resistance, became support. You look at You just look at that. That's perfect. Bam, bam, goes through, comes back down to it, comes back down to it, goes back up. So you get Micron in the low 30s, you really ought to buy some. All right, couple seconds of questions and we'll call it a day. Yeah, I spell things wrong on purpose sometimes. Overlays, right? So like if you want to, you know, it's got to be, so I want to compare SPY. You know, can you compare two comparisons? Yeah, I guess. I mean, Micron, even with as volatile as it is, kicks the crap out of SPY. So when the two numbers get close together, you for sure buy it, right? So if this comes down and it gets close to SPY's trend line again, then you would expect it to mountain back up. So yeah, there's some validity to doing that sort of thing. I don't do much of it. I just take a look at what the alpha and the betas are and try to figure it out from there. But it's good visual representation, Julia. Okay, so you're missing something on the interest rates. If interest rates normalize in the next decade, it's because we printed trillions and tens of trillions of dollars and paid off a whole bunch of debt. The debt doesn't exist anymore if we normalize interest rates. That's the point. So if we print $60 trillion to bail out Social Security and the Fed balance sheet, which is bailing out everybody else, all of a sudden there's 60 or 70 trillion or 50 trillion, whatever the number is, in new treasuries out there, brand new cash. We come, you know, at that point we roughly balance the budget. It doesn't matter if interest rates go up, right? The economy doubles in size. You've effectively devalued your debt by half or more. Doesn't matter if the interest rate goes up. So would you rather have $100 bill, you know, have $100 loan that you're paying 3% on, 2% on, or would you rather have a $50 loan that you're paying 5% on? Give me the $50 loan at 5% all day long, right? So if interest rates go up 2 or 3 points, who cares? If the effective value of the debt is half. And that's what happens when you print all that money. I like EA, AT, you know, right? I mean, there's several other video games out there. I should do a comparison of that, but I came to the conclusion that I liked EA better. I can't even remember why anymore. Yeah, so why Aoi, you know, from China? I alluded to that in the presentation, is, you know, the part of the Armageddon scenario is this trade war spins out of control and messes up supply chains. I'd be very concerned about that. I don't think it's going to happen. I think the clock is going to run out on President Trump before this happens. But, you know, we'll see. We'll see. Hey, he's taken hydroxychloroquine or whatever, apparently. I mean, I can't even wrap my head around why he said that, to be honest with you. So let's suppose Micron gets down to 35, right? I'm probably selling the $35 put because I want it to be assigned to me. And I'm just collecting time value. I don't want to set the put so low that it's not likely to get assigned to me, right? So that's selling a put is about collecting the time value and trying to game when the stock is going to get back over, right? So, you know, let's say it comes down here in the next month or two. And if it's in the low 30s, I might even sell a put that's way up here at 40, just and put it way out to like November. to collect all that time value of money, right? So ultimately, I think you want to own the stock. It's just a matter of how do you get there. So it's very easy to measure the institution. I mean, this is, so on these charts that I use, oops, that's not what I meant to do. I meant to do this. This is an algorithm that charts institutional involvement, right? So Micron has been seen buying lately. But if you go back to SPY, right? The institutions just started turning up, but that was after, right? Go to the other time frame, and now look. They're not. They're sellers all of a sudden. So this algorithm does track that pretty good. You don't like to be right at the start of institutions selling off. And you got to remember that a lot of the institutional pressure right now is the ETF creation. And what happens when the big money doesn't want to buy? So the big money, again, is family offices. And you can track that in Institutional Investor Magazine. So they put out their asset allocation trends a couple times a year. They're not buyers. They haven't been buyers in a long time. It's a pretty good algorithm. So, all right, we'll there's always a better algorithm, but this one I think has been, take a look. That's, this is a negative, unless this turns green imminently. There's a major negative divergence here on this rally, right? That's what you have to take away from this, right? So this better stay green or this rally is done. So keep that in mind. The other thing is to take a look at your rolling moving averages. That's not a good trend, right? It's not a good trend. So that means imminently it could go down. And that's becomes big selling pressure. I don't know that we're likely to see this. I mean, we might see this, we might see this, might see this, might see this. So again, I'm not saying that there's not a scenario for a prolonged bull market where we just have a normal retracement and then we head back up. That's a possibility. I don't think it's the number one possibility, but it's a possibility. The other scenario is that we head down out of this box, little rebound, head down to this line, little rebound, head down in here. I think that's the most likely thing. But to be prudent, you got to buy a little here, buy a little bit more here, and then load up down there. Pretty simple, right? I know there's several of you that can't get through your head yet that this isn't about speculating. This is about game theory. This is about playing out the scenarios. I don't want to be a buyer up here. I just don't. And I just started the short. I'd cover my shorts down here, maybe do a little nibbling. I'd buy more here because I don't know if it's going to keep going down. And again, we do the measurements of cash flow, of money flow at the time. Can't predict the money flow a month from now or 2 months from now. World changes quickly. And then down here, there's just major, major support levels. So you pretty much have to start being a buyer. So you can decide for yourself if you think the to the moon, the resumption of the bull market is happening. I don't. But you're allowed to. It's your money. Or do you think we're going to get a second crash? I do. Is there an Armageddon scenario? There is. That sucks that it even exists, but there is. So you take a look at those three scenarios and you use this prudently based on, if I'm covering my shorts here and buying back my covered calls, maybe I don't buy any stocks. other than some of the SP 500 inclusions that I like. Then down here, I'm probably buying QQQ. And down here, I'm just backing up the boat, backing up the truck, backing up the boat. You can back up a boat too. So stop looking at this as, oh, I'm going to guess what's going to happen in the future. Take a look at the scenarios that could play out. Take a look at the evidence. Then lay out what your game plan is. This is mine. You do you. I'm going to cover my shorts around here. Do some very selective buying. I'm going to get very involved with QQQ in here. And I'm going to get almost every dollar I have invested down here. Pretty simple. Yep. I am seeing a third-ish of the people not wearing masks. And there are an awful lot of people out in public. And on Friday, I'll do my update of the infection and death curves. And what you're going to see is not going to be pleasant. So you can think that reopening is the greatest thing in the world and that we should be doing it. This doesn't really mean open. Reopening doesn't mean open. It just doesn't. Because you're still going to have half or more of the population keeping themselves very scarce, keeping their spending very low, especially all the people who are losing jobs or unemployed. It's not going to be quick. I think that the U-shaped scenario is the most likely, and I don't think we get a significant turn up in the economy until about a year from now, maybe a little less, maybe a little more. I think that the economy continues to get worse through the end of the year. And the stock market in particular, because the wave of bankruptcies that is coming that you're just starting to see, they're in the news. These bankruptcies are going to just really hurt the real estate market. And that is tied to a lot of derivatives, which is tied back to the equity and bond markets. I've got 15% of my money in those bond funds now. I got 15% of my money in gold stocks, mainly covered calls on top of it. That's a third of my money. Then I got another 20 or 25, 30% in stocks, and most of those have covered calls on them. Still sitting on that 40, 50% pile of cash. That's where Buffett is. You want to argue with me, just understand that you're arguing with Buffett. Because I'm doing the same thing he's doing. Different investments that I'm in. He's got all those operating companies and a handful of stocks now. But as far as asset allocation goes, pretty similar. We're both around 50% in cash. That's a big pile of cash, and there's a lot of good reasons for it. But if you want to hope that valuation's never going to matter again, and you want to hope that people are going to magically get their jobs back, and you want to hope that the economy is going to make a V-shaped recovery, you go ahead and hope. I think it's a horrible strategy to hope like that. At least in the short term. Long term, it all works out. All right. Have a good day. And tomorrow I'm doing an interview and then doing a little babysitting. So I will be on a Seeking Alpha interview later this week, early next week. I don't even remember what we're talking about right now. It might be the energy markets. Take care.